The deal with Kylie Jenner was an absolute disaster. It was actually doing very well. The trajectory was on point. We were seeing good ROI. Within 30 minutes, she deletes the post and says, I need to post a different photo. But she ends up sending us some new photos that are just the worst photos I've ever seen.
Kylie Jenner's name explodes across the feed, except this time the signal isn't a sold-out lip kit or a viral makeup hack. It's silence, spreadsheets, and a slow-burning backlash that feels more like a chart than a clapback. We're not here to dunk for fun. We're untangling what happens when fame meets faltering revenue and brand credibility gets tested in public. This is the moment the culture notices the math.
10 minutes before a post is supposed to go live, it was one of those times in early Instagram where they'd have bugs. So 75% of the world had a bug where Instagram crashed. And we're texting her team, postpone the post. She posts it. So that's how the deal went. It ended up being okay and a huge learning lesson.
Remember the origin story. A teenager turned a DIY lip kit into a cultural event and a cosmetics empire. That original hustle created explosive demand, but momentum is a fragile thing. E-commerce numbers that once read like victory laps have cooled dramatically, with public reporting pointing to a drop from peak online figures down toward the high 20s by 2024. A reality check that changed how investors and fans see the brand. Beyond raw numbers, the brand's story shifted. Early Kylie sold intimacy and access. Later efforts leaned into eco-friendly and clean claims after a 2021 relaunch that repositioned formulas and packaging. That pivot, framed as values driven by the company, landed unevenly with longtime customers who wondered whether the change was litigation-driven, strategic, or simply cosmetic. The rebrand conversation has been a durability test for trust. Kylie's playbook shifted. Diversify fast. The launch of Sprinter, a canned vodka soda, and the push into apparel with Kai show a founder chasing lifestyle breadth instead of doubling down on core beauty. Sprinter's retail rollout proved she can still open doors into national shelves, but retail presence is not the same as repeat e-commerce devotion, and it doesn't always translate into brand love over time. There's another structural wrinkle. Kylie sold a controlling stake in her beauty empire to Coty in 2020, a move that gave the brand scale, but also ceded control. Ownership dynamics matter because operational decisions and prioritization now sit partly with a global conglomerate. Kylie has reportedly explored buyback options in the past, which shows how founder control and governance influence both strategy and brand perception. Coty itself has been publicly re-evaluating its consumer beauty portfolio amid wider market weakness, which creates a layered problem. When your corporate partner signals strategy reviews or divestment options, that reverberates back to founder-led lines and changes stakeholder expectations. Strategic reviews by big players often spur consolidation, so celebrity brands must either defend their space or prepare for reclassification. This is cultural terrain, not just corporate finance. Celebrity brands trade on a unique contract. Fans give attention and in exchange expect authenticity, a storyline, and a sense that the founder is personally invested. When that contract feels broken, when posts prioritize wardrobe or nightlife instead of product narratives, consumers feel estranged. That estrangement scales into cooler conversions and meaner memes. Gen Z, the cohort that made Kylie a household name, is merciless about carbon, ethics, and authenticity. They don't settle for celebrities as credentials. They want receipts. Labels that fail to offer ingredient transparency, honest pricing, or long-term product validation face not just criticism, but economic consequences when shoppers vote with dollars. That shift turns PR into performance metrics. Hype decays, and the law of diminishing returns is brutal in beauty. The first few drops were events. The 15th drop is noise. Meanwhile, indie brands and revamped legacy houses now compete with better formulations and smarter community marketing, slicing the margin for celebrity labels. If influence is the opener, product is the doorman, and the doorman is stricter than the audience that located the first theatrics. There's no single scandal that sunk Kylie. The harm is cumulative. A misfiring campaign here, a tone-deaf image there, lowered web traffic, and a corporate partner rethinking strategy stack into a verdict. The internet's judgment is slow and merciless. It's a compounding of micro-failures that together change how people show up at checkout. The modern consumer demands accountability and product leadership. Being a storefront face no longer suffices. Brands need credible science, transparent sourcing, and a community that feels heard. If a celebrity label leverages fame without substantive product depth, critics will call it opportunism, and indifferent shoppers will quietly move on. Operational realities are unforgiving. Managing supply chains, R&D, retail relationships, and global logistics is hard work that often doesn't make headlines. Selling to a conglomerate solves some operational headaches, but can introduce strategic inertia if the founder's vision and the corporate strategy don't align. That misalignment looks like silence to the public. So what are reasonable options? One path is investment. Double down on formulation, test products rigorously, and lean into community partnerships that reward long-term loyalty. Another path is financial. Negotiate governance changes or pursue a buyback to regain creative control. A third path is strategic pivot, leaning into licensing and letting others steward products while she focuses on living aesthetic lifestyle. Each choice changes the brand's DNA. Context comes from the larger family portfolio. Kim Kardashian has reorganized her beauty assets and shifted SKKN back under the Skims umbrella in 2025, a consolidation move that simplified brand architecture and refocused consumer conversation. That contrast matters because it highlights two routes: consolidation and reinvention versus dilution across many small bets. What Kim did there, quietly folding SKKN back into SKIMS, reads less like a PR stunt and more like a masterclass in brand triage, the kind of adult decision-making that single-handedly separates celebrity side hustles from lasting consumer institutions. While headlines love the drama of spin-offs and splashy launches, Kim chose the slow art of simplification. Reduce cognitive load for the customer, centralize storytelling, and make it easier for every micro decision. Browse, add to cart, repurchase, to land on something coherent. That move telegraphs an understanding that true brand equity isn't built through a million small bets, but through a few big, obvious bets done well. A tidy lesson in product architecture for any influencer-turned-founder who confuses momentum with strategy. The optics are surgical. A consolidated architecture makes marketing cheaper, creative calendars cleaner, and product narratives easier to defend when journalists and investors start poking. Kim's play is also a governance play. Consolidation lets you allocate capital efficiently. If the audience response to SKKN was okay but not extraordinary, folding it under the SKIMS umbrella means the parent brand can absorb, iterate, and either scale what works or quietly sunset what doesn't. That's the opposite of celebrity scattershot. The launch first, ask questions later energy that dilutes attention and exhausts followers. It's a tacit acknowledgement that brand launches should be experiments with metrics attached: retention, repurchase, and long-term margin. You don't need to scream newness every quarter. You need to prove that consumers will come back again and again. There's cultural competence baked into the move, too. Kim's audience expects curation and utility. SKIMS built trust by solving a problem, comfortable, flattering underpinnings with a wide size range and a tone that felt inclusive. Translating that trust into adjacent categories only works if the product actually solves something or elevates a daily ritual. Folding SKKN into SKIMS signals that any beauty or skin move will be held to SKIMS, standards of utility and accessibility. It's a promise to the customer. If it wears the Skims stamp, it has to pull its weight. This consolidation also reframes the family dynamic as portfolio optimization rather than sibling competition. The Kardashian-Jenner collective looks like a holding company of taste, each asset with its audience and function. When one sibling reorganizes, the ripple effects read as stewardship rather than panic. Kim's choice implicitly teaches the rest of the family: own fewer things deeply, or be ready to accept that some of your brands will be niche, ephemeral, or strictly licensing plays. For Kylie, whose tentacles reach into beauty, fashion, and beverage, Kim's consolidation offers a template. Either double down and institutionalize, or accept that you're running a series of bulletins, not a company. Investor psychology notices this kind of adulting. Markets like clarity, private investors like predictable unit economics. Consolidation doesn't just help customers, it helps CFOs forecast and analysts model. When a founder consolidates brands into one umbrella, you eliminate brand overlap costs, concentrate marketing ROI, and create a clearer narrative for future fundraising or exit scenarios. It's cleaner for potential strategic partners, too. A single, robust Skims entity is a more attractive partner or acquirer than a scatter of small, loosely related labels. Culturally, this move also rewires expectations about celebrity ownership. There was a moment when celebrity meant control by visibility. If you posted it, you owned it. Now, ownership is increasingly measured by structural choices: board seats, IP control, meaningful revenue participation. Kim's consolidation looks like someone who understands that founder equity isn't just in the logo on a product. It's in the systems that make the product persist beyond a post or a trend. That's the difference between being a moment maker and being an institution maker. From a marketing perspective, folding SKKN back into SKIMS tightens the story pipeline. Content can be cross-pollinated more sensibly. Styling videos become skincare tutorials, product drops can be choreographed to broader seasonal stories, and the creative team can invest in multi-channel narratives rather than one-off stunts. That's where the economics of attention become efficient. You stop paying to create separate moons and start investing in planets with gravity. For a cultural commentator, the move reads as less flash, more infrastructure, a maturity Hawksmoor would admire. There are reputational dividends too. Kim's been through enough public cycles that silence or overexposure can both be hazardous. Consolidation lets her control the narrative without constant noise. You can pivot the conversation from another celeb launch to here's a holistic lifestyle brand with credible skin and body offerings, which plays better in long-form reviews and retail buyer meetings. In other words, it's easier to earn shelf space and serious critiques when you aren't begging for attention on 3 different fronts. But consolidation isn't without risk. Folding a smaller brand into a larger one can erase the niche audience that initially cared enough to buy. If SKKN had unique fans who loved its specific aesthetic or ingredient story, that intimacy risks being absorbed or lost. The challenge is to integrate without homogenizing, to keep the halo while leveraging the scale. Do that poorly, and you alienate the initial tribe. Do it well, and you expand that tribe's access to better distribution and more product innovation. Finally, the move reframes what luxury means in the celebrity economy. Luxury used to be scarcity. Now it's curation and coherence. Kim's consolidation is a thesis that luxury is less about limited drops and more about a sustained, curated relationship with the consumer. That's a different kind of cultural power. The power to set tastes over years, not mere weeks. It's the difference between a fleeting viral moment and a style that defines a generation's aesthetic habits. Perception is sticky. Founder visibility, product storytelling, and the cadence of community engagement define the narrative. If Kylie chooses fashion and paparazzi moments over lab tours and ingredient explainers, the narrative settles. It may be a cool narrative, but it's not the one that rebuilds trust in a competitive beauty category. A credible comeback would be tactical and slow. You don't buy trust in a single ad. You earn it in incremental wins, multi-month third-party testing, influencer partnerships that test and report honestly, and transparent supply chain stories. It's boring, but boring can be lethal when it restores credibility. Investors will watch the operational signals, stable repeat purchases, improving review sentiment, and a clear governance plan. If metrics improve, headlines will flip. If not, the brand risks being recategorized as nostalgia rather than a growth asset. Culturally, this is a test of celebrity capitalism. The influencer boom proved attention could be monetized. The maturation wave asks whether attention can build institutions. Some do it well. They become product companies with talent and governance. Others remain high-performing content machines that license their names. Both models are valid, but both require honesty about what they are selling. In the short term, watch 3 signals closely. First, steady, trusted product reviews that demonstrate repeat usage. Second, transparent corporate signals, filings, or credible reporting that clarify Cody's intentions or the roadmap for founder control. Third, visible founder involvement. Kylie in labs, Kylie explaining formulas, Kylie showing the work. Those 3 together can reverse a narrative. Silence can be an intentional strategic pause, but silence without visible accountability concedes the narrative. In the social era, perception collapses quickly into economic reality. The brand's next public moves, product detail, partnerships, or a buyback narrative will be treated as evidence, not spin. If none of those signals arrive, indulgence fades. Fans unsubscribe, conversion cools, and the brand slides toward a licensing role where celebrity equals access but not product trust. That's not a death sentence, but it is a recalibration of value and legacy for a founder whose early promise was product-led authenticity. The media will feast on the contrast. Think pieces about authenticity, investor memos repackaged as cultural critiques, and endless TikToks parsing product experiments like evidence in a trial. That media churn can help a comeback if it's accompanied by substance, or it can accelerate decline if the substance is absent. Buying back equity is seductive. It's a narrative of ownership, control, and return to roots, but it's risky and expensive. Kylie has been linked to buyback talks in prior reporting, which signals both interest and complexity. A repurchase at a lower valuation could be smart if tied to rigorous product investment, but it's reckless if it's just a branding move without operational follow-through. For consumers, the upshot is simple. Purchases are votes. If fans want founders to be accountable and products to improve, shopping choices reflect that preference. The era of passive fandom is ending. Engaged consumers now demand evidence and reward brands that deliver it. This is the crossroads. Kylie can quietly rebuild with product rigor, governance, and community nurturing. Or she can lean into a lifestyle model that monetizes fame without promising product supremacy. Either path rewrites the playbook for celebrity commerce. So hit subscribe, drop your hot take, and tell us, do you think Kylie can buy back the brand and rebuild? Or is this the quiet beginning of a long tail? Leave a comment, and we'll keep watching the receipts. Now let's go deeper into the emotional ledger. Kylie's early career created a type of intimacy that was performative but felt private. Quick videos, candid selfies, and dialogue that made fans feel seen. Over time, that intimacy was monetized into repeat drops and product archetypes. The risk with turning intimacy into commerce is that the currency devalues if you exchange it too rapidly for cash. Fans will forgive a founder for missteps if they can see the labor, the tests, the prototypes, the admissions of learning, but they will not forgive a cascading sense that the founder is present only in press events. Rebuilding that relationship demands visible labor. It demands showing process alongside glamour and accepting that vulnerability in product making is more persuasive than glossy perfection. The storytelling problem is real. Social media rewards spectacle, but product loyalty rewards substance. Kylie's feeds are masterclasses in spectacle, glamorous photography, aspirational lifestyle, and curated moments, and that aesthetic sells attention. But attention is not the same as loyalty. The conversion funnel that once fed Kylie Cosmetics was tight because fans wanted to be part of the launch theater. Now audiences are more skeptical, accustomed to reading reviews, consulting creators who test for months, and demanding repeatable performance. Conversion now requires evidence beyond a face and a drop calendar. Operationally, the company needs the right stewards. Being a celebrity founder is an advantage when you bring vision and reach, but it's a liability if you outsource the core innovation. A hybrid model works. The founder remains the cultural voice while a committed product leadership team does the slow, boring work. That team must measure repeat purchase rates, consumer satisfaction over months, and the number of 5-star reviews on independent platforms. If those metrics move, the narrative becomes quantitative. You can show a curve, not just a mood. Culturally, failure or correction from a star of Kylie's scale is instructive. The internet will polish a legend as easily as it will tarnish one. The better response is not to retreat from attention, but to redirect it. Use visibility to educate, to show process, and to celebrate tiny iterative wins. That requires recalibrating content calendars to include substantive storytelling, lab visits, Q&A with chemists, creator forums where independent reviewers are compensated to test and report honestly, and behind-the-scenes episodes that become documentary proof, not promotional theater. Let's parse the family dynamic with clarity. The Kardashian-Jenner family operates like a diversified portfolio, and each sibling's brand experiments feed the collective brand equity. When one sister consolidates and double-checks product depth, the ripple reassures consumers. When another launches several lifestyle bets without clear ownership, the signal is fragmentation. That's why governance moves, consolidations, buybacks, or focused investments look less like retreats and more like adulting for a portfolio that once grew fast on cultural momentum alone. A practical PR playbook looks like this. First, announce an independent audit and invite third-party labs to publish findings. Second, seed long-form product journalism that focuses on efficacy, not influencer glamour. Third, launch a creator fellowship that funds trusted reviewers to run months-long testing panels and publish transparent reports. Fourth, visibly renegotiate governance so headlines show a founder-focused revival rather than a corporate shrug. Those are not sexy moves, but they change the math by rebuilding trust incrementally, one verified measurement at a time. The truth is messy. Brand health is measured in small, repetitive acts. It's measured in return purchase rates, in the tone of product reviews, in the frequency of repeat orders, and in the way influencers and micro-communities talk about formula efficacy months after launch. It's measured in shelf life. Does a product stay relevant in 6 months, a year, or does it get discounted into oblivion? For Kylie, the tactical work is to create those small, repetitive encounters that accrue trust over time. And that means setting expectations for slow wins rather than fast viral hits. We also need to be honest about media incentives. Outrage and novelty generate clicks. Long-term rebuilding doesn't. That mismatch makes it hard for founder-led brands to get credit for slow fix work. The media ecosystem rewards theater and penalizes patience, which is why the smartest comeback stories always include visible milestones, a respected reviewer's long-form endorsement, a meaningful retail restock that sells out organically, or an investment in R&D that results in a genuinely new, defensible formulation. Those are the moments that flip headlines from "brand is failing" to "brand is earning back trust." If you're following this for the receipts, here are the exact things to monitor. Product sentiment trends on review platforms, sustained e-commerce traffic patterns, and any corporate disclosures from partners that reveal strategic intent. Watch for visible founder-led content that goes deeper than glam photos, lab tours, chemist interviews, and multi-week creator testing rounds that produce real data. And watch retail behavior. Sell-through rates and repeat buys matter more than initial retailer placement. Drop your hot take below, subscribe for more cultural takes, and share this video with someone who still thinks fame equals forever. I'll keep tracking the receipts, and we'll see if silence becomes a comeback or a case study. Until next time, question the narrative and demand honest proof.